There are a lot of macroeconomic reasons for housing prices going up as much as they have over the last couple of years. There's, of course, demographics, the zero interest rate policy of the Fed for the last 15 years, government stimulus, and a lot of other things. But one of the most powerful reasons is a shortage of housing supply. Or if you want to put it in non-economic speak, there's just not enough houses in the United States. According to a recent report from Realtor.com, this problem is actually getting worse. And this new data suggests that the US housing shortage could shape the residential housing market for years, if not decades to come. So today we're going to jump into this. And first, I'm going to start by just providing some historical context about this housing shortage, where it came from, what it all means, how we got to where we are today. Next, I'm going to update you on this most recent data so you can understand which direction things are heading. And then lastly, we're going to talk about what this all means for home buyers, for investors, and yeah, even for renters. Before we get into all that data and everything else, I want to tell you about today's sponsor, Ridge Lending Group. Any mortgage can give you a loan, but as a real estate investor, you need more. Ridge Lending Group is an investor-friendly mortgage company that can strategize with you to make sure you're getting the most out of your loan and your real estate portfolio. With licensing in 48 different states, they have helped countless investors achieve financial freedom through real estate. RLG is not a one-size-fits-all lender. They provide individual, in-depth education, strategy planning, and long-term support for their clients. Not to mention world-class service. With loan programs to fit almost any need, they can work with your scenario and find the best lending product for you. Ridge Lending Group makes it as easy as RLG. Call today or apply now at ridgelendinggroup.com. That's ridgelendinggroup.com. Let's talk about the housing shortage. The current housing shortage that we're in right now actually goes back to the 2008 financial crisis. Many of us remember what was going on back then, but this was a housing-led crisis and a housing-led recession. And as a result, a lot of businesses that operate in the housing industry went out of business, most notably builders. A lot of construction companies could not make ends meet. They closed down shop, never to reopen again. And as you can see in this chart here, that means that construction of new housing units in the United States, this chart shows new housing starts, that's basically how many houses are started construction on. It absolutely plummeted during the financial crisis, and it took years and years and years to get back to even where we were during normal times during the 90s, not even during bubble times like the early 2000s. And it's not like, construction completely stopped during that time. Actually, in the years from 2012 to 2023, there were about 13.4 million housing units completed. So that's a lot, right? And 9.5 million of them were single-family homes, which is generally what people want to live in, and about 3.9 million were multifamily units. And this may sound like a lot. Remember, it's 13.4 million, but you have to think about whether or not that is enough to meet the demand during that same period. And to measure demand, we're going to use a metric called household formation. And if you haven't heard of this metric before, that's okay. A lot of people in housing or generally just think that demographics like population growth is the best way to measure demand for housing. But I recommend using household formation, and here's why. Population just shows how many people are moving to an area or are born in an area. It doesn't necessarily mean that those people want housing, right? So you might have babies that are born, and if their babies' parents or guardians have a house, then that increase in population doesn't necessarily translate to more demand for housing. On the other hand, household formation basically means how many individual people or family units or groups of friends want housing. So if you have 2 or 3 roommates living in a single flat together, that's one household. Even though they're not related, that's still considered in economics, according to this metric, one single household. But if those people decide to break up and go their own way and get their own apartments, let's say there's 3 of them, that would mean 3 households. So 2 new households were formed. They were all living in one, now they're living in 3 units. So as I hope you can see, this is a better metric for measuring housing demand. And so during the years of 2012 to 2023, which as a reminder, there was 13.4 million housing units completed during that time, there was 17.2 million households formed. Assuming that you start from neutral, like everything was perfectly balanced, if household formation outpaces supply growth, you get a deficit, and that is what we have right now. We have a deficit. And this has been a well-known issue for years. And just as a quick refresher, if anyone is a little rusty on supply and demand, if there's more demand than supply, like we're talking about here, prices face upward pressure, right? There are too many people competing for too few homes. And that means, generally speaking, according to economic theory, people will bid up the prices of those homes or those rental properties because there's just not enough of them. Now, it's important to remember, as I said at the beginning, that this deficit is not the only thing explaining the rapid housing appreciation over the last couple of years, but it is a major one. So that's gone on like 10 or 15 years now. And that brings us to today. The question is this problem getting any worse or better? Well, this data from Realtor shows us that single-family residence starts, again, how many construction project got started last year, it fell 6% in 2023. So it's down from 2022 levels. But that is actually not that bad. It's actually way higher than it was in most of the 2010s. It just seems to have peaked for this cycle in 2022. And a lot of reason that's happening is really coming down to rates. Generally speaking, builders lose confidence. They build less when mortgage rates go up because they're forecasting lesser demand because affordability has declined. So that was just single family residence. When you look at multifamily, the story is a little bit different. There are much fewer starts this year in multifamily, but there are a lot more deliveries, which basically means that the construction projects are completed. As you can probably imagine, multifamily just takes longer for these things to be built. So even projects that were gotten started in 2022, early 2023, are still getting completed here in 2024. We still have some supply coming on there for multifamily, which is a good thing for the housing shortage, but that's actually a whole nother thing. We'll get into that in another video and talk about multifamily supply because it's worth talking about. In 2023, we had 1.5 million units completed, but there was 1.7 million households formed, meaning the deficit got worse. And this means, according to Realtor, that the gap has increased from 7.3 million to 7.5 million. So that is a huge deficit. Now, it's important to note that other sources other than Realtor.com study this kind of stuff. Many of them consider the gap smaller. Like just as an example, Fannie Mae, one of the big mortgage companies, considers the gap to be around 4 million. But I don't know exactly what's the right methodology. They just use different statistical measuring methods, but directionally, they all seem to agree. Basically, they all agree that there is a housing shortage and we're not building fast enough to make any progress against it, and it's probably getting worse. So the question is, if all these economic firms and housing firms agree, what does this mean for housing? On a national level, the implications here, at least to me, are pretty clear. Housing supply is going to continue to put upward pressure on housing prices for the foreseeable future. Now, that does not mean that housing prices are necessarily going to go up. When I say upward pressure, I am factoring in many different variables that impact the housing market. Mortgage rates, demand, the broader economy, the labor market, all of these things. They exert pressure on housing prices. Some push up, some push down. But this variable, this very important variable, which is housing supply, is not likely to change for a while. So that's why I say it's going to continue to support higher housing prices over the foreseeable future. Now, of course, things could change. Like if the macroeconomic forces change, there could be more downward pressure that could overcome this upward pressure and push housing prices down. But I just want you to know that there's a major thing supporting housing prices. To me, that's the major lesson here on a national level. But as always, things are going to be really different regionally. Housing is very localized. Some markets have plenty of houses and are not facing this particular dynamic, but most don't. According to Realtor, 73 of the top 100 metros have actually seen household growth outpace building permits in recent years. The biggest one over the last year was San Antonio, Texas, followed by its neighbor, Austin, Texas. Then you see other big major growth areas like Deltona and Daytona Beach, Florida, and then Allentown, Pennsylvania. So in these types of markets where household formation is most rapidly exceeding the new supply of housing, both housing and rents will likely remain high. Now, I've sort of explained why housing might happen this way, but rents will also likely stay high because regardless of who owns the house, if there are more households than properties to occupy, housing is going to get more expensive because there's a deficit. So that's what we got for you today. Hopefully this Realtor report is useful for you. You can click on it. We'll put a link in the description below. It has a bit more information. You can go in a little more detail there, but I would love to know what's happening in your market. Do you notice a shortage of housing supply? And how can you tell? How does that manifest in your market? How do you see that there's not enough housing? Let me know in the comments below. And remember, if you like this type of housing and econ data, make sure to check out my podcast. It's called On the Market. You can find it here on YouTube or anywhere you listen to podcasts. Thanks for watching.